Is this a correction, or is there a long period where we see the markets in a bear grip? Let's discuss this. For a global perspective, Geoff Dennis is joining us. He's an independent emerging markets commentator. And Mayuresh Joshi is also joining us, head of equity at William O'Neill India. Gentlemen, good evening. Geoff, to you first. This pressure that's building on as far as the acceleration we are seeing from US GDP numbers, it's definitely going to have an impact on Indian equities like it would on other emerging markets. But I started out by saying that, some of these GDP numbers that the US is reporting could put emerging markets at shame. If you're going to see that resilient and American economy right now, despite the kind of geopolitical concerns that India seems to be dealing with, how do you see FIIs move?
Well, first of all, obviously the GDP number we've just had is history. It's the third quarter and it's gone. And it's been one reason why I think bond yields rising in the US, one reason why the Fed has remained very tough in terms of their rhetoric on interest rates. And therefore, one reason why the dollar has been pretty strong recently, certainly remained very firm. And this is what's all helped to put emerging risk assets generally have been weak recently, particularly equities. I'm not that worried about the 4.9% Q3 because I think what matters now full looks like, and certainly we'll get a slowdown. I'm not sure we're going to get a recession, but we're certainly going to get a slowdown. And I think that that's what people are going to focus on here. So I rather agree with your previous commentator that depending on where US bond yields go from here, and I think we've got to be somewhere near the peak, I suspect this sell-off in equities worldwide is probably close to an end.
That's one side of the story, Mayuresh. What's your belief? Right now, it seems like we are in a bearish phase of sorts. You could see it as a correction. But do you think this could extend longer, keeping in mind the moving pieces like oil prices, like perceived Fed action now, and how US bond yields, like Geoff is alluding, how they've been surging, keeping these pieces in mind, how do you think the Indian markets are going to move from here?
Very good evening to you, Vikram. I think the markets, specifically the Indian markets, are reacting to a cocktail and influence of three events. One, as Nikunj rightly mentioned, what is happening on the geopolitical front, if this escalates, I think that is a fear not just for the Indian equity markets, but for equity markets across the globe, being risk assets. And if the escalation happens, what happens to oil prices, so on and so forth. So I think the geopolitical risk is something that the markets, both Indian and global, are bracing themselves for. The second element, obviously, is the slew of incoming data that is coming through. And for the US markets in particular, the data is particularly strong. So I think even our team in the US probably believes that it is going to be a soft landing that the US will probably see. And that will mean that the kind of corrections that you're probably seeing in global markets, which is part and parcel of the bull market cycle that we are in at the current juncture, might just be a temporary phenomenon. The third element on an Indian context, structurally, Vikram, is that both on a macro and a micro front, we are far better off than most developing and developed economies, albeit the GDP print, which has just come for US third quarter numbers right now. But I think the numbers in terms of GST collection, tax collection, inflation probably expected to remain under control. Liquidity seems fine for the system as a whole. And therefore, from a macro perspective, India seems to be far better off. And earnings are coming in as expected by the street and the market itself. So there is no two ways in terms of why foreign investors will not probably look at India among all the emerging markets or the developed markets as well. And therefore, if the correction comes to, might be a short-term phenomena. Our ticket market Smith, India, is that we will probably wait for the next few days to see how these events play out. And if the markets find an intermittent bottom, and we do hope to get a follow-through day after that, I think the markets should be in fine fettle. So I think the perception, at least as we speak, if things don't worsen on any of these three counts, is that the bottom should be in place over the next few days or a couple of weeks.
Fair enough. You sound pretty sanguine about this. Geoff, for the moment, we've seen the US dollar experience this broad-based weakness after the release of that GDP data, the jobless claims as well, and of course the durable goods orders report also came through. Now, what's the traction that American bonds will get from investors? Do you see a strong move right now towards debt across the board?
That's I think in many ways the $64,000 question, because I think the driver of a lot of this weakness really has been bond yields, which has had all these effects that I mentioned earlier. And I think what you're getting with US bonds right now is, I think, not just concerns about higher for longer in terms of interest rates, but also concerns about supply, because the budget deficit numbers in the US are frankly enormous and frightening. $2 trillion US budget deficit in the last fiscal year ending in September the 30th, which is nearly 8% of GDP, the sort of level which would put a lot of emerging markets under downgrade risk. And of course, you've got QT, not QE anymore. So for me, what happens to bond yields? Now, I still think that the US economy is not as strong as that a Q3 number would indicate at 4.9. I think it will slow down. I think the risk of recession in the next 6 to 9 months is not zero. It may be low, but zero. And inflation, which is ticked up a little bit recently, is going to eventually head from the currently around 3.5% level towards 2% in the second half of next year. This is what makes me think that probably somewhere around 5% 10-year yields, we are somewhere near the peak. And if I can, add this point, which you asked me before and I didn't answer, I think ultimately this will put the dollar under a little bit of downward pressure and will bring money back towards the emerging markets, including FII money towards India. And I wrote something a couple of days ago where I said, what do emerging markets need to improve their shocking performance this year? And I said, you need to have China turning, you need to have yields peaking, you need to have the dollar therefore peaking also, and you need the geopolitics, as your previous speaker said, not to get any worse. That's a tall order, all of that. But at the end of the day, I think US bond yields are probably somewhere near the peak, and that's, I think, what we should watch above all.
Well, talking about China, we did see that stimulus measure being announced, and that had a positive impact on global markets. But Mayuresh, looking at sectors, and we were talking about metals only yesterday, which are the sectors that you favor in the markets right now? If you think that this is just a correction within a bull market, there is a phrase called "aapde mein avsar." Do you think that's what Indian investors have right now? And if they do, then what looks most promising from a medium to long-term perspective if one is building a portfolio and had a sense of FOMO during the recent stronger bull run, if I may call it that we've had?
Oh, absolutely. Our take is that what we're probably putting in on our watch list on the sectoral allocation perspective, Vikram, is the banking and financial space. The numbers have been pretty good so far. And even if you account for some element in terms of compression of NIMs going forward, both for the banks and the NBFC universe at large, the expectations in terms of a lot of buffers at play, the deposit growth has been good. The advances growth is expected to be spectacular over the next couple of quarters as festivities begin. On top of that, asset quality pressures have come off for a whole host of players within the space. And with provisioning expected to improve even further, or what exists on the balance sheet at this juncture, and a right mix in terms of capital adequacy that they probably possess, along with the risk-weighted assets to total assets, I think they're absolutely well placed in terms of spectacular growth over the next few quarters. So I think this is one sector that definitely remains on our watch list as the markets bottom out. The other sector might also be some selective stocks within the IT space. Again, with the US data coming through, it doesn't seem to be worse off in terms of discretionary spending trends that might emerge at the end of Q4 in the Indian context, Q1 in the US context. And therefore, pricing stroke demand-led pressures should start getting reduced as we head into the next 2 quarters. Obviously, third quarter is a little bit weak because of furloughs, but a lot of commentaries, specifically in the mid-cap IT universe, seem to be very, very positive in this respect. Having said that, again, I think if the worsen of factor happens, I think some defensives like pharma will come to the fore, which becomes a balanced trade in terms of both earnings remaining stable over the next few quarters and expectations in terms of key product launches with good margins supporting bottom line growth for a few of the pharma companies where leverage is not a factor and where FDA concerns also should not be such a headache compared to the rest of the pack. And last but not the least, I think capital goods stroke infra, selectively, if they do correct even more from the current levels, they become a very attractive bet because the kind of investments that are expected to go through, both from the public and the private side over the next few quarters, the kind of orders, the margins at which orders will come in, the execution and the working capital cycle will basically mean that the earnings cycle for this particular stocks within these sectors should grow at a very, very healthy and decent pace. I think these 3-4 sectors would definitely be on our list.
So despite what we are seeing right now, there is talk of resilience within the Indian markets, despite the kind of correction like we'd like to see it right now. And you're seeing the kind of global cues that we are getting, especially from the US, with a very resilient American economy coming through from those GDP numbers that came out earlier today. Thanks for putting that in context, for throwing the light as well as to where you see both the American markets, especially the bond markets, and how the Indian equities are likely to react. Geoff and Mayuresh, many thanks for joining us on India Tonight.
Thank you.
Thank you.